So let's just talk about how private equity model works. Essentially, limited partners, people basically with money, pension funds, high net worth families, go into a limited partnership. Through a manager, they will buy a company using private equity, the capital that they've raised. In some cases, they will use high-yield mezzanine debt, borrowed debt, and bank debt to complete a transaction to buy a company and basically buy out the existing shareholders and pay off the existing bondholders or bank. So it's really, quite frankly, that basic, although Eric is going to explain it in far more detail than I am here. Now, one interesting question is this, is that there's always a general partner. Somebody has to find these transactions. Somebody has to manage how these companies are run. And typically, the fee for the manager is a combination of 2% and 20% of profits over a hurdle rate. It begs the question of, are they worth it? So we should look at the numbers and see how that checks out. It may also beg the question of, who are these people? Who manages private equity? So we could look at it because there's two schools of thought about this. The first school of thought says they're basically just a group of sharks in suits, or they're effectively a lot of MBAs walking around with chainsaws trying to take the heads off unwanted staff. So that's one view of private equity. Now, to be fair, Eric is wearing a suit tonight, but he's not a shark. So this is more likely what they are. Northleaf is a company that we work with as well, and I chose them because they've been around a long time. So they have 60 professionals, they manage $6 billion, and they've been there since 1969, which means they have data for a long period of time. So we took a look at that data. Here's their return. They measure themselves against the S&P 500. And over 3 years, they've actually underperformed the stock market, which is also true over 5 years. But once you look at 10 years or 20 years, the numbers completely reverse. So in a bull market, which is what we've had for the last 5 years, just keeping up with the returns on the bull market would be a major accomplishment. But when you blend a full cycle of markets, bull and bear markets together, you get something that looks like this is a long-term difference. And their expectations are that they can add 5 to 6% a year over publicly traded markets over full market cycles. Our first exposure to private equity as a firm was with a Vancouver private equity firm called Maxim. We did that in 2008. We raised, I think, around $14 million from roughly, I'm going to say, about 120 clients participated in this. And they're just winding down that fund. They've started their next fund. The IRR on the first fund has netted after fees around 16% a year. So they accomplished exactly what we hoped they would accomplish. They did a great job. On infrastructure issue, we work with Brookfield. Infrastructure is really quite different than private equity. The capital required to be in infrastructure is huge. Brookfield has $48 billion alone allocated to this space. So it generates a good yield up front. It tends to be both diversified and offer inflation protection over its long-term rate of return. So it's a great complement to private equity in a pool. In terms of returns, they measure the global infrastructure returns against the global stock markets, which are measured by the MSCI World Index, the Morgan Stanley Capital Index. There's the global infrastructure securities, and there's the global equities. So you're taking less risk. That's what this graph is indicating. To the left is less risk, to the right is more risk, and a higher return. So that's your ideal outcome. Now, with all of these issues, of course, the big trade-off is this. Liquidity is given up. In public markets, you have liquidity as long as you want. In private markets, you have restricted liquidity, and that's one of the major reasons for the trade-off in returns. If we take a look again at their performance over 1, 3, and 5 years, a little better than markets, maybe over 5 years, public markets, but significantly better, again, over an extended period of time. So, what's the best way to manage the risk within private equity? So Northleaf has come up with this interesting diagram. What it says is, on the left here, the chances, if you make a single investment in a single company, you have a 40% chance of some loss and a 30% chance of losing all your money if you were simply making one investment in one company. You can reduce that risk to almost 1% of total loss and 30% of some loss if you're in a fund, but you can basically eliminate both risks if you're in a fund of funds. So that's one of the reasons why Northleaf and we chose the fund of funds approach, because the effective cost of actually layering a fund of funds and using that diversification works out to be about 1% a year. So if your target return was, say, 12 or 13%, would you give up 1% in order to get that kind of reduction in risk? So we assume for us and for most of our clients they would. So our allocation currently is we have 40% of our assets in our private equity pool in fixed income for follow-on investments and commitments we've made, 30% in infrastructure, 14% in mezzanine funds. Mezzanine funds are high-yield funds. Instead of putting equity in a company, they're lending money to a company, typically in the range of anywhere from 10 to 14% in today's interest environment, and direct investments as well, direct co-investments. So that's the structure of the fund.